Should you buy tips as a hedge against inflation? Unequivocally, you should. My man Orlando emailed me. He's got a bunch of money just kind of laying around in his IRA. He goes, what do you think? Should I buy tips? And I said, let me look at it. And he sent me this ticker, V-TIP from Vanguard. And it's been a long time since I talked about tips. And I'll share with you why here in just a second. And I said, I'm going to move this guy. Okay. So this is Vanguard short-term inflation-protected securities. And the thing that was interesting is we got 4.67 as a distribution yield over the last 12 months, the trailing 12 months. If you actually run these numbers, 48 cents, 87 cents, 95 cents, 48 cents, and you divide it by the current share price, it's about a 5.5% distribution yield, which is crazy, man. I'm still not quite sure about the negative SEC yield. I kind of do remember that, but I forgot, and I don't feel like really researching it. So at the end of the day, all I care about is total return. So anyway, so I said, what exactly? It's been a long time since I've done tips. And one of the reasons why I checked this out, we're going to compare tips to the total bond index at Vanguard. And check this out, man. Look, $10,000 invested in tips was worth, in 2013, $10,016 in 2018. It hadn't grown, literally hadn't grown. Isn't that nuts? $10,000 invested in 2013 was literally worth the same amount 6 years later. Now the last 1, 2, 3, 4, in our fifth year now, it's up 20%, 16%. But isn't that crazy? I hadn't made any money, so I just forgot to talk about it, frankly. And then my man Orlando said, man, it paid 5.54% last year. I said, what? So let's look at what it did in 2020 compared to today. No, we'll go to 2021, the last year. There we go. So check this out. BND is down about 8% so far, but yet look at that, man. So here we are. The blue is the tips. 10,000 we put in is worth $11,000 bucks. But 10,500, excuse me. 10,000 we put in BND is down 8%. That's not huge, but for a bond, it's pretty big, pretty significant. But look at that. So if we get a significant inflation, continued, and I mean, who knows? I'm always about hedging. I'm not a gambler. I don't think you should put all your eggs in one basket, regardless of what your old buddy Josh says. Say, man, you have some stocks, you have some bonds, you have some cash, you have some gold, you got some storage, you got this, that, the other. I want real estate. At the end of the day, if inflation continues on like this, tips are going to be profitable. And for me to deny that, well, I'm a big fan of deflation prospects. And I just want to be clear. When I say deflation, I'm not talking about Great Depression. I'm talking a la Japan. And if you just look at Japan, the GDP was basically nothing. A couple years was negative GDP, a couple years up, but it was basically floating right around that 0% area that sometimes with negative interest rates, zero interest rates, sometimes it's just 10 basis points, just float right at that 0% corridor. That's kind of what I expect in the United States. Low unemployment, low growth, low to no inflation, low interest rates. I 100% think that's going to happen here. But I could be wrong. And if I'm wrong, look at the tips. They speak for themselves, man. I mean, look at that. And let's go over the balance. This is a pretty interesting article. How do they work? Again, it's been a long time since I looked at tips, just because they haven't done much. But they pay out 2 ways, based on an increase in the CPI, and they yield above inflation. They can lose value when the CPI drops, but never to the point where you lose your money. They will continue paying out twice a year until they mature. All right, and so they pay interest twice a year. They differ in that the principal changes based on CPI. The rate of return that investors receive reflects the adjusted principal. So again, I'm not quite sure what the negative yield is. There's an article or two you can find. It'll explain. I just forgot. But I do know the total return is 5.5%. So essentially, they adjusted the principal. So you got 5.5% over the last 12 months on that bond fund, where bonds are getting smoked. Not a bad deal. So that's a perfect hedge. 5.5 on the up for tips, -8 on the down for BND. Let's see. Suppose the Treasury issues an inflation-protected security with a $1,000 face value and a 3% coupon. The first year, you'll get $30 and 2 semi-annual payments, so $15 each. That year, the CPI increases by 4%. As a result, the face value adjusted to up by 4%. So not only are you getting the coupon at 3%, you're getting a CPI increase of 4% as well. They're paying you twice, which is pretty cool. In year 2, the investor receives a 3%, but it's based now on the 1,040 as opposed to the 1,000. So you get 3,120 as opposed to 30 bucks. Pretty cool. In year 3, the inflation drops to 2%. The face value goes up 2% to 1,060, and the investor receives 3,182, 2% on the new face value. Because the face value goes up with inflation. The process continues into the bonds mature. That's freaking cool, man. Once the bonds mature, investors receive either the adjusted higher principal amount or the original investment, whichever is greater. You can never lose money in this. You can never lose money. Now, you might not make money, I just showed you. But if principal declines in periods of deflation, which I expect, but again, it's not like Great Depression. I'm talking Japan, so it probably won't be much. But whatever, I could be wrong. The big one is you want to buy these in IRAs. The increase in face value of the bond does trigger taxes each year. All right, so you want to buy them in IRAs for sure. TIPS are also highly sensitive to changes in the prevailing interest rates. As a result, you could lose your money if you sold your TIP prior to maturity, especially if interest rates go down. I'm a big fan, man. So I appreciate Orlando making me aware of this. I definitely think if you have some money sitting in an IRA, TIPS would be a good hedge for sure. I mean, look, you always want to say, what if I'm wrong? Not just Josh, you. What if I'm wrong? If I'm wrong, then I want to make sure I'm exposed, that I don't have too much exposure to the risk that comes with being wrong. Hope this helps. Love your thoughts.